Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the show. We appreciate it. Real quick before we get started, depending on when you are hearing this or watching this, there may be time to come to the Inner Circle event that's happening May 7th, 8th, and 9th in Dallas, Texas. If you're interested, go check out Hard Money Mastermind, innercircle.com. When we're planning these events, it's always kind of a moving target in terms of how many people are actually going to show up. Just because we have 25 or 30 people in the Inner Circle does not mean that they all make every meeting. So we end up with sometimes a room that's too full, and then sometimes a room that's got a spot or two open, which is the case now because a couple people aren't coming. So go check it out, Hard Money Mastermind, innercircle.com, and we hope to see you in Dallas. All right. Today we are talking about inherited properties, and we titled it Beware of Inherited Properties because these situations come with an additional level of risk. And, it could be one or two properties inherited. It could be sometimes a whole portfolio of income properties, and different things can happen. But the source of the risk is the fact that the person who now owns these properties because they inherited it, they didn't build this portfolio themselves. They may or may not have a background in real estate investing, construction. Usually they don't, to be honest. Yet they have this asset that needs to be managed, might need a lot of work, and they might not be, they might not be able to do it themselves.
And think about this real life situation. Somebody inherits a property. Let's say it's worth $300,000, right? It's inherited. It's worth $300,000. It's in disarray. It needs a lot of work. Maybe it's a residential residential property. They come to you and says, "Hey, I got this property free and clear. I need to renovate it, and whatever. I want to flip it. I want to turn it into a rental, whatever the case is, and I need $100,000, right? $100,000 to do so. On paper, that's a pretty darn good deal, right? 33% LTV, very low exposure. For the most part, seems like it could make sense. Well, on a collateral play, absolutely, it does make sense. But it might not necessarily make sense on the borrower and the personal guarantor play if they can't execute on the project. Like, let's be honest, if you're not a sophisticated real estate investor or developer or contractor, $100,000 construction project is a big project, right? There's a lot of things that could potentially go wrong. Now, let's say they inherit that property and, again, it also depends on the situation, but maybe they don't have much money and they can't make monthly payments and they don't have cash reserves. So you say, okay, well, can you roll in some of the payments? Sure, I'll roll in some of the payments for you. Well, what happens when the payments are due? What happens if there's overage? What happens if they don't have good credit? Keep in mind, if you don't have good credit, how else are you going to get capital if you need it, right? Like, got to put it on a credit card. You're not going to get a bank loan. You're probably not going to get a cash advance, right? Like, it's hard for them to get additional capital if they need it. Now, again, these are just things in general to be aware of. That doesn't necessarily mean that you can't do it or you shouldn't do it, but you got to think through a lot more of the situation than just the collateral and just the equity in it. We like to say inside our business that about 10%, maybe a little bit more than 10%, or what we call kind of down and dirty deals, where they're lower LTV deals on a little bit riskier, situations, maybe borrowers. And that doesn't mean like we don't want to do them. We just have to make sure they're going to perform because the borrower quality, if you're trying to build a good lending portfolio, borrower quality is so important because the last thing you need is a whole bunch of deals that are at low LTVs and you have great equity on that don't make monthly payments. That's not good for you for cash flow. That's not good for your capital investors that are expecting monthly payments from you. So depending on how your capital's structured, it's something you got to really, really look into and consider before determining if you want to do a deal like this.
Yeah, let's dig in a little bit more related to underwriting borrowers or guarantors, right? Because at the end of the day, they will make or break this deal, right? You as the lender, you don't have much control. Like, you gave them a loan, you probably have a construction reserve. The rest is up to them. You can't do it for them. You can't make monthly payments for them. You can't do the construction work for them. And there's no one else involved. And so they can do different things like with this deal based on different levels of performance, whether they knock it out of the park, sell it for a bunch of money, or like do the right job and get a tenant and a refi in place, or, you know, give money to the wrong contractors and kind of lose some of the money that we funded from construction, and then they get stuck, and then they should sell the property. This happens all the time. People get in a position where they should sell the property. Maybe a project went sideways, but they really don't want to. Maybe this inherited property has sentimental value and they cling on to it and make poor business decisions to do so. Oftentimes, the right move is like to bail. Like if this thing went sideways, sell it for whatever it's worth as is right now and get out of this situation. Like don't get in the, get eaten up by default interest and legal fees and late fees and everything else. But people choose to do that all the time. We see it all the time.
Yeah. Real quick, and then keep adding to that. And one of the reasons why is, let's say they bought that property for $300,000 in cash, and then they came to you to do a refinance to renovate it. Like in theory, hey, it's the same thing. They have $200,000 in equity. Like they still got it. Who cares how they got it? But in reality, it's not. It's completely different. If someone put in their hard-earned cash that they earned from themselves, not inherited, they earned, and they bought that property and then they renovated, they are incentivized as hell to in essence, to do whatever they can to make that work. That's a freaking mental shift, right? If it's the same thing. If you ever bought like a coaching or mentoring program or a boot camp or something in the past, if somebody gave you that product or that access to the training for free, you'd be like, I'll get around it when I do. But if you spend, $100,000, $10,000, $100,000 to be involved in that group, you're going to do whatever you can to succeed and make it work. It's a mental shift, and it's the same thing with real estate investing, or with them as real estate investors.
That's right. They say the more they pay attention, and that applies to real estate too. So, okay, we see scenarios like that all the time. We have one. I'm going to go back to underwriting borrowers in a second. We have one currently where we didn't lend to the person who inherited it, but so we did a bridge loan on a rental property in New Jersey to a real estate investor who seems like he knows what he's doing. Got a few different properties, got some cash flow, has a lot of equity. Fine, we did a bridge loan for him. He ended up passing away. And so now I believe it's his siblings that are in the process of inheriting a few of his properties. And I've spoken to them, and the file is in the early stages of foreclosure process now. And I just know they're going to make poor decisions. I can tell by the conversations we've had. And they're going to end up morbidly clinging to this property, even though they can't get a refinance or loan paid off. And anyway, like I was saying before, that stuff happens all the time. It's more inherent risk with people who inherit properties. So how are you supposed to underwrite a borrower, a guarantor, in the event that they inherited a property? So first, I would start to see if maybe you got lucky and they're a real estate investor. They're probably not. The majority of the population isn't. But maybe they have real estate background of some sort. They have construction experience. Maybe they're a real estate agent. Maybe it's something in real estate, right? I'd start there. All right. Say they don't have any of that stuff. I would take a look at what they're doing career-wise and in their professional lives. Are they successful in a completely different field? Maybe. If they're successful in a completely different professional field, there's a good chance that they could be successful at this project. And then also, if they're not, if it seems like they don't have a whole lot of business going on in their lives, they're probably not going to do a good job at this business deal. It seems like it's not what they do. They're not business operators of some sort. So I would take a look at that. And, depending on your risk tolerance, depending on your portfolio performance, you may or may not want to do that low LTV bridge loan, construction loan for an inherited property. You may or may not.
Well, yes, especially with a big construction project. Another story, and I mean, we've have lots of situations just from doing 3,500 plus loans over the last 17 years related to all of this stuff. Can't say seen it all, but we've seen a lot. Another example we did a loan for a borrower who inherited pretty good commercial asset, right? They needed some money to, in essence, renovate. They had some capital improvements that they needed from another commercial building that they're involved in. But anyways, long story short, did a low LTV loan, 30-ish% LTV on a nice income producing commercial property, right? No construction needed, no anything like that on the subject property. And, they have a hard time because they're not professional real estate investors. They inherited these properties. And yes, they make the cash flow on them. And yes, they're good properties. But like the father or the mother, I think the father and the mother were both the investors and the property manager on them. The daughter and the son are not, right? They don't know how to negotiate with their tenants. Their tenants are moving out. Their tenants are unhappy. Like they're real commercial assets with real tenants. They're trying to renew leases and do this and do that. And then they'll get behind on a payment and be like, listen, you shouldn't be getting behind on payments. You're getting plenty of income on this. And then they make the payment. And, it's somewhat babysitting. It's like, wouldn't it just be easier for you to sell this property? They don't know what the value is. They want to do what their parents did and they want to follow that path. Like until there's enough pain for them, they're not going to have that aha moment of like, you know what, maybe I'm not a real estate investor or a commercial property owner. Maybe I should just sell this thing. It's like you have $1 million that you could cash in on this thing. Just sell it, go invest into some passive investment. And chances are you're probably going to get a better return off that anyways than you would, dicking around with these, tenants that are abusing you because you don't know how to work with them or negotiate with them. And then you have capital improvements that come in. So again, that's not to say that, you can't have good, win-win situations. Just be careful, right? Beware of it. All things considered, a lot of times when properties are inherited, like Chris said, they're not sophisticated real estate investors that are flipping them, right? And they're not making the same logical decisions that maybe we or you would be making, the right decision. One other really quick story before we wrap this up. I remember having a conversation with someone who inherited a property who's like, yep, I inherited this property. I own it free and clear. It's worth a few $100,000. This is my chance to be a real estate investor. And he wanted, $100,000+ to renovate it and things like that. On paper, collateral wise, it was no brainer. But at the same time, I was like, I don't think this guy's gonna be able to execute and do so, which he didn't. But in real time, I was like, you know what? How much do you think you could, if you really do a nice job and renovate this property, how much do you think you could flip this for? And whatever, the answer was that he gave me, I was like, okay, and I was like, but if you just sold this property as is today and you didn't get a loan from us, you just sold it as is today, you could almost get the exact same price. Right? So why spend a year to renovate this property with the hope and the risk of the market appreciating and you selling the property? Why not just sell today? Cash now is way better than cash later. He's like, yeah, it's a good point, but I really want to be a real estate investor and I feel like this could be a good one for me. And it's like, you potentially are going to make less money by flipping this property if you just sold it as is or wholesale it to another real estate investor, or whatever the case is. That's just what happens. So, got to have common sense, and sometimes you got to coach some of these folks to make the right decisions.
Yeah, a couple additional notes on that, and then we'll wrap. So, that's been a common theme recently at HMB in our discussions with our business partners and our portfolio manager, that borrower quality is very, very important. They can really change the outcome of what happens in a deal drastically. And we try to take a good look at the people who we don't yet know. Obviously, we lend to a lot of the same people over and over again, which is a great part about this business. But half the people we lend to month to month, we've not done a deal with before. So we try to look into their track record. Hopefully, they have one and a decent one. People provide their spreadsheets and REO experience, stuff like that. You can also find an MLS, public record, to see the deals they've done in the past. And even if they're a little bit light on that, like I was saying before, we take a look at, other aspects of their lives, like credit, like the cash available, income, where do they live, right? Are they renting an apartment or do they own a house and have for a long time? What do they do for a living? What do they do for cash flow month to month? Get a good grasp on who they are as a business person and see if you have a good gut feel that you vouch for this person to make their payments and do the construction job. And you ask yourself that question, and sometimes it's going to be like, I don't think so. And yeah, I mean, over time, like you do enough loans, hundreds, thousands, like we have, like you can kind of predict how people are going to perform simply because you've seen it so many times. So yeah, wanted to rant a little bit on that topic. Be careful with inherited properties. They're out there. They look for private lenders like us, and that's totally fine. And they could be deals. Just be very aware of the additional risks that come with these. And like I mentioned before, check out Hard Money Mastermind InnerCircle.com. It's last minute, but if you can make it to Dallas on May 8th and 9th, we'd be happy to see you there. Just schedule a time to talk to our program director at Hard Money Mastermind InnerCircle.com. And we'll see you guys here next time on the podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.